corporations, S corps, LLC, stuff like that. And so without further ado, help me introduce our next speaker, Silas Green! Give him a warm ovation. Give it up. All right, give it up.
Good afternoon, everyone. I want to thank you guys for having me out. The fun face. It's hard to come up here after sexy elevator. What do I do? My eyebrows don't move this well. I was practicing in my seat like, okay. So I talk about taxes, but once again, my name is Silas Green. I'm a CPA. I work for Sunshine Pro Accounting and Tax out in San Mateo, California. Today, I'm going to give you a general tax update on some things that you guys want to keep in mind as you go through the process, as well as we're going to talk a bit about different types of business structures. Who here owns a business? Exactly. Who here pays taxes? All right, that's important because we all have this thing that we can utilize some different types of strategies and structures to better benefit ourselves in managing our business. So, think about 2018. 2018 threw us off for a little tax reform came in, everything changed. Now we're looking at a whole tax dynamic that we weren't expecting. 2019 will be similar. But the thing that we have to understand that there are some things that we want to keep in mind. So as we go through, the tax rates are lower for individuals and for businesses, which is great. Something that we can take advantage of as we go into the process. The standard deduction increase. So we all pay taxes. We all have to do an individual tax return at the end of the day in spite of our business. So we want to keep that in note as we do our taxes. There's a lot of itemized deductions that's changed. A lot of things we thought we can deduct from itemized deductions we did prior to 2018 we can't do now. But one thing we want to keep in mind is we still have opportunities to strategize, utilize those deductions, and could use them in other places. May talk about that a little bit later. And for businesses, that's a 20% tax deduction on ordinary business income. That's something we can take advantage of as we go through the process of understanding what our tax liability will be at the end. And then we want to increase in capital write-offs. This may not impact yourself, but it's something that will impact a lot of people we'll talk to in these conversations we have. People with businesses, they want to understand what they can write off. Capital deductions increased to 179. The state taxes exemption increased a lot. This is something you can go in planning and keep that in mind, as well as the one big thing is in 2025, everything could change again. So, we're in for a pretty good dynamic as we grow our businesses and things go on. But the IRS still hasn't clarified everything. But I'm going to show you something up here. The tax brackets are different this year. There are 7 tax brackets versus 5 prior to this. This is important to know. When you start meeting people in the different tax brackets, when your tax brackets start to hype up, understanding where you are can help you understand when and how you want to take certain income, because you can move some income to a different tax year versus not, to reduce that income being taxed at a higher bracket. When we think about capital gain rates, these are long-term capital gains rates. These are tiered as well. If you have income in a lower rate, you're not paying any capital gains tax. But you have income, and income starts to grow, that tax rate increases. Now, this is for long-term capital gains. All short-term capital gains are taxed at the ordinary income rate. So when we start thinking about these things for our personal selves and the people we're meeting with these financial situations, we want to understand that and let people know that, hey, if you can hold off and think about when you take these gains, you can have some great benefits. Standard deduction, I just want to remind you guys of that. And also, a lot of us have children. Also, we all, teen learners as well. We still can take these credits. So, the Merit Opportunity Credit for our kids who are still in school, lifetime learning credit, things we can take for a long time. And if you guys utilize 529 plans, they expanded some of the ways you can actually take these distributions out without paying taxes of up to $10,000. Now, when we think about issues for small businesses, the 199A deduction, the 20% tax deduction for business, things that we have to manage, we can utilize that. Meals and entertainment, well, let me say that again, just meals. The IRS no longer allows you to take deductions for entertainment. So those are things that we got to take out. But On the flip side of it, being in California, you can still take deductions for entertainment. So the IRS doesn't allow for entertainment, but California does. Small business owners can also utilize the cash method. So different entity types, the IRS expanded the definition of small businesses, so we use the cash method, which makes accounting a little easier for small business. We'll continue going. So let's talk about business structures, getting to that. So one of the simplest structures we all know of is sole proprietorship. The thing with sole proprietorships, they're simple. You know, we say, hey, I'm gonna have a business. You're a sole proprietor. All you need is a DBA. You don't have any extra tax things you have to do for the state. You pretty much get a DBA and you have a sole proprietorship. But the thing with sole proprietorship, there's no distinction between you and your business. You are your business, the business is you. So your personal debts, liabilities are all subjected to risks associated with whatever activities you do. The next phase is partnerships. What is a partnership? Hey, I'm a sole proprietor, you're a sole proprietor, let's do business together. Two businesses can also be partnerships as well too. But here's the kick in that. If I'm a partner and I have another partner, my partner decides to do something that I don't agree with, I'm jointly and severally liable for my partner's activities. So, but, you know, there's risk associated with that. Operating agreements are great if you have partnerships. If you have partnerships now, you don't have good, effective operating agreements. We talked about some of these things in some of the early presentations. You want to protect yourself from risks associated with partnerships. There's additional tax filings required with partnerships, which is 1065. This is sometimes an easy way to start relationships with business owners that do similar things, but you want to make sure you take advantage of having effective agreements, contingencies in place to protect yourself as a partner. Now, the next thing we're going to talk about is the limited liability company. This is a hybrid. So, hybrid company, you can actually be taxed in different ways as a limited LLC. LLC requires you to have specific forms filed with the state to become an LLC, and it's state regulated. So, in addition, you also have to pay a minimum tax on an annual basis. So there's a fee associated being an LLC. In California, that's $800 per year as a minimum tax, and that increases as your income goes up. But the cool thing about LLCs, you can be a pass-through entity. For example, you're a sole proprietor, and you say, I want an LLC. Like many sole proprietors and small partnerships become LLCs because they need more credit. Now, business entities, if they do business with, they say, okay, this person not just a person that woke up this morning and say, hey, I want to be a business, now I'm a sole proprietorship. At least the LLC makes it more credible structure. In addition, you have the ability to be taxed as a S corp or corporation. We'll talk about those next. So corporations. Corporations is our Amazons, our Googles, our Facebook, big companies. Now, you can be a small corporation as well. But the thing about the corporation, the entity owns all the profits and losses. This gives some opportunity for there to be double taxation. It's not automatically double tax, but it's a situation where you have to manage the tax associated with the corporation and person. Now, with the lower tax rates, there are some dynamic opportunities to evaluate where you want those incomes to be taxed, but utilizing that the corporate structure gives you some benefit. Corporation has perpetual existence, which means that it will live long after you pass on. This is due to the fact you have opportunities to use stock and stock options to manage a corporation. This is ideal for companies that need a lot of capital. You want to use stock as a better way to grow capital. You want to use venture capital financing. Corporations are really good for that. But let's talk about small business corporations, S corps. Now, this is a dynamic thing that we want to talk about because S corporations are really good for individuals in consulting positions. It's a pass-through entity, but the profits are distributed to shareholders, but it can be distributed in different ways. So, for an example, we can have income splitting opportunities because we who own S corporations are owners and employees. What happens with this is that we can have the profits be utilized as income as well as distributions. And the distributions, you don't have to pay self-employment taxes on there. So the way you can minimize the tax you pay on the income you earn. There's annual state requirements as well as federal requirements to start a corporation. Like I said earlier, LLCs can be S corporations as well. With that being said, this is a unique area that we business owners in this room can utilize, because the things that is unique about what we do, there's not a lot of capital to start this. There's high margins associated with our business structures. With that being said, high margins, low capital, profits that you have to pay taxes on, using income splitting opportunities with that, with the proper due diligence, can give you some good opportunities to reduce tax liability associated with S corporations. So, going on to the next. Now, preparing for success. We still got some things we can continue to think about for ourselves and people that we, talk about with our financial situations to minimize our tax going into tax season. You can always still contribute to our retirement account. You get that deduction up to $415. Itemized deductions is something you always still want to consider. For one, you can still maximize the deductions from a California perspective. And two, many itemized deductions for us business owners can also be deductions for our businesses. So if we can't deduct it on one schedule, there's some opportunities to deduct it in the other schedule if you utilize it properly. Organize your records, because you'd be surprised that one of the biggest issues with small business owners is they have underutilized deductions. Because, well, I didn't track my miles, so I'm only going to say I drove a few miles. I didn't track all my meals. I don't want to get in trouble, so I want to keep the meals deduction low. The thing is, if we have good records, there's no reason why we can't maximize these deductions. And then in addition, if we start early and get things together, we can also use estimates. Estimates is something that the IRS allows if the estimates is rooted in source documentation. Having a CPA or a tax professional kind of support me to say, okay, what is a good estimate for mileage? What is a good estimate for meals? These things can give you opportunity to maximize those deductions, minimize your tax, and put yourself in a better position where those income streams that you're bringing into your businesses, because many of us have multiple income streams, we're not being taxed too much. So with that being said, one of the things we want to talk about is protecting yourself from fraud. I'm always want to highlight this because as individuals, there's a lot of fraud that can happen. The IRS will never call you and say, hey, you owe us money. They'll never send you crazy letters asking for information that you don't, that seems weird. Emails, be careful about that. These things will happen. Check your credit report to make sure all the bureaus have consistency, because fraud is something that we all will be part of, directly or indirectly. For your businesses, develop a security plan. This is important for all our businesses. We need a security plan. We have home offices. We work remotely. What is the plan to secure your data, your systems? Because you have proprietary data that people can get into. And make sure that the networks that you're logging into, when you're going into these data, going into these meetings, are secure. If you're not using your own secure network, your mobile network, be careful about what you're logging into, meeting someone at a Starbucks, meeting in the hotel. These are areas where you can have the risk associated with that. And audit. When I mean audit regularly, it's for an example. You ever walk out your door, you lock it, you give it a jiggle? Audit your files. If you have security protocols associated with your database, your networks, the training you gave your staff, the people working with it, make sure it's in place. Make sure when you jiggle the door doesn't open, everyone can run in and get all your data. Now, I'm going to remind you of a few key dates. If you have an S corporation or a partnership, your taxes are due 3/15. You can extend it to 9/15. Then, of course, the April 15 deadline for individuals and corporations. Just keep that in mind. You have plenty of time, but you want to make sure you don't fall short of the opportunity to get your records together, organize, and plan ahead. Now, final slide. Everyone's situation is different. We all here because we have connection to this business, these products, these services. DTA is going to go big this 2020. But in spite of having this connection, each individual tax dynamic will be different. So if you have questions, feel free to catch up with me throughout this weekend. Shoot me an email or call. I can give you some support and guidance if you have specific questions, how any of these things that we talked about today can be implemented in your personal tax planning position, or you have some general questions for any edification that you would like for your own personal understanding. Well, I want to thank you guys for having me.
Hey, can we give it up for Silas?